So invested in majors, mid-tiers and juniors. The key things, the majors, they're essentially a blue chip stock and they'll pay a dividend. The juniors, the capital growth is driven through discovery. That share price of Andy Well that we put up, the 3 peaks of that share graph all coincided with discoveries. So it really does drive the wealth of these junior companies. If they're mining a quality asset, they'll do well. And also, juniors, they risk being taken over, which from an investor, can't be a bad thing. There's always a premium on takeover. The mid-tiers rarely pay a dividend. The same points apply as the juniors, but they can also grow through M&A of taking over juniors or fellow mid-tiers. But again, they're at risk of being taken over by the majors themselves. Some things to look for: is the company meeting its guidance each quarter at the all-in sustaining costs that they forecast at the beginning of the year? If not, why not? And it doesn't have to be negative. As you saw with CNC's guidance, they highlighted that there's times where there'll be climatic conditions in rainy seasons, that they might not be or accessing lower grade parts of the ore body, and they're already forecasting areas where they might be producing less ounces. So it's not always a bad thing if they're not producing what they say they are at the time, as long as there's a reason. There's some guidelines for investing in the junior gold sector. You need to look at the size of the deposit that they're mining, the location of the deposit. Is it in the middle of nowhere? Is it half a kilometre underneath your feet, or is it at surface? Ownership of the deposit. Are they in joint venture with someone? How much of the profit are they going to end up with? The experience and the quality of the management. The potential and the immediacy of production. This is important. This comes down to investor patience. Is it something that won't get put into production for another 5 years? Or is it something that a company that's taken over an existing mine and they can get it into production very quickly? Financial and soundness and sustainability of a company is something to look for. And the enterprise value can often represent the takeover value of a company. If resources are stated, a judgment can be made as to what the size of the resource is that the company thinks to have in the ground. Comparisons and analogies can then be made to determine what the company is worth relative to its peers in the market.
If you look at hedging, my view on hedging is it's a risk mitigant. It's a way to raise capital, and it's a way to lock in prices to ensure a certain level of income whilst you're trying to put a project into production. And typically that comes with project finance from a bank. Streaming is the other, methodology or way to raise finance, whereby you forward sell some of the gold, usually at a pretty significant discount, for equity or debt. I think hedging hasn't been favoured when gold price is high, and that's that's pretty typical of people's views. My personal view is I'm not against hedging. I think used appropriately, it's a good risk mitigant for the company. And then I suppose the challenge for most of the people in this room is are they making an investment in a company because they want exposure to a higher gold price? If that's the case, then your exposure will be reduced. What we have seen in the current market, where it's hard to attract capital, we have seen quite a few streaming deals. Streaming deals can be quite precarious. I think if you've got a multi-commodity asset, i.e. if you look at a lot of the Mexican gold and silver projects, it's quite easy to stream, for example, the silver, which makes a lot of sense. You can then attract capital by that, but you're still getting most of your revenue from the sale of gold. The challenge if you're a single commodity and you stream a single commodity is you significantly reduce your future incomes. It's nice if you're the person who owns the stream, but if you're the company, you can find yourself in financial distress by streaming if you're a single commodity company. And we're seeing quite a few of those scenarios globally now, whether it's North America, Australia, Asia, where companies are in distress because the gold prices come back and they're not generating the revenues they anticipated they were.
If I may offer some insights from my experience when I covered Australian mining companies on CNBC, the argument at the time was that the more companies hedge, the more complicated the whole story gets. And sure enough, they might protect themselves on the downside. But in those days, this was about 10 years ago, Jeff, there was really a move away from hedging simply because they were limiting themselves on the upside. So, Jeff, the question, I suppose, is, and Alan, whether you think that mining companies are now much more likely to just suffer the exposure because of the capping of the upside.
Yeah, certainly the quantum of hedging is a lot less than it used to be. And typically you see that when the gold price goes high, people try and sell out of their hedges to maximise that exposure. There is rhetoric in the markets at the moment about people looking more closely at hedging, but we haven't really seen an increase in the quantum of hedging from gold companies in the past 3 or 4 years. If anything, it's continued to decrease.
Again, in Singapore, we're not too familiar with usually, but it's the issue of native title. In other words, the rights of the Aboriginal communities to the land where some of these mines might be located. The issue first arose about 25 years ago, and since then a lot of mining companies have started to work with the indigenous communities. To what extent, though, is this still the sort of issue that could scupper a project if the local indigenous community raises objections through the Native Title Tribunal?
It can do, but companies do a lot of good work, especially the larger companies as well, doing heritage surveys, educating their workforce on Aboriginal heritage and culture. And prior to going out and doing, I used to work exploration through Western Australia. Before we went out and drilled, we'd have to go out and get the permission from the Aboriginal community. And it's very important to do that, to engage them and go to their communities, drive them out to the area where you want to drill. Because when you say you're going to be drilling and your exploration, you saw the picture of a drill rig that I'd put up there, they automatically think big hole in the ground, big yellow trucks. And it's like they don't understand the work that needs to go in to before you even get anywhere close to mining. So they really appreciate actually being taken out to the area, which is in maybe the middle of the bush, and being shown that all you want to do is drill a small hole here, here, and here, and it really opens their eyes up as to what you're doing. Now, as far as scuppering plans, there are stories of leases and mines that have been held up in there, and it probably will continue. But the education that is going on is certainly benefiting that.
I just had a question on reserves and resources. What's the what are the rules? I mean, in the US, you use a 3-year rolling average for the gold price in terms of determining the price at which you determine, whether the reserves and resources are economic. What's the rule in Australia?
Well, a lot of companies will have their own criteria for working out those prices, and they'll usually give a neutral price and also a robust price, best case scenario, and a distressed price as well. So they can operate within that range, do various scenarios in those the two extreme ranges, and then that will come up with their neutral range. So it does vary by companies, it varies by the actual deposit itself, as to certain characteristics of the ore body that will convert reserves into resources on that particular ore body. So things with gold deposits is like I said, they're not created equal and they're not the same. So one set of rules of drilling out an ore body to a certain, when I say drilling out, I mean, do we drill 5 metres by 5 metres by 5 metres? If that's okay for one mine, another mine, it might be fine to drill it out by 10 by 10 by 10 if the ore body is much more consistent. Whereas if it's all faulted and offset, you're going to need a closer drill pattern to try and find out exactly where it is. So unfortunately, it's not a one-size-fits-all.
I would use a rolling price, a 3-year, rolling price. I'd be suspicious of companies that, if we look at the current gold price around $1,170, if they're using $1,500, why are you using $1,500 when that's not the current gold price? There's not a hard and fast rule, set by the exchange. Simple as that. A lot of it comes back to the QP who does the work, what the company and the QP agree on for resource and reserve statements.
And that is a good point as well with reserve and resource, especially reserve statements, when it should always state what price that the metal price used has been calculated on. So something to always look for, and something else to look for is when we were talking about gold that's with other commodities, usually copper. sometimes you'll see something expressed as a gold equivalent as well. Now, a gold equivalent is only as relevant as the metal prices that are used. So if you see something expressed as a gold equivalent, you've got to look at both commodity prices that they've used to put into it. So not just the gold price, but the copper price they're using as well, or zinc, lead, or silver, whatever goes into it.
Let's talk about getting exposure to gold, which is, I suppose, and you touched on it just now, Jeff, when you mentioned ETFs. The Singapore Exchange obviously allows you to get exposure to gold through the SPDR gold shares. In other words, all you get is exposure to the rise and fall of the price of gold, but not the exposure to the mining company that actually pulls it out of the ground. Could you give us some sense as to why investors should even invest in companies? If they want an exposure to gold, why not just strip out all of that execution risk and just go straight with the gold price, with the SPDR gold shares?
Yeah, well, I think you touched on it. I mean, if you have an ETF type instrument, your exposure is purely to the movement of the gold price. Whereas if you've got, if you're a shareholder in a mining company, you've got exposure not only to the gold price, but I suppose what is a maturing business that's going from something that needs capital to something that's generating a return. Alan's slides presented it quite well. There was a slide there where it showed the typical evolution of a mining company, and the points 4 to 6 where you see the project come into production, it starts generating positive cash flow. It's a maturing business that has, I suppose, shifted in the value curve, and typically that's recognised in the share market. So, while it's higher risk probably than an ETF, there's potential for greater reward because you've got the gold price and, in fact, you've got a business. Ideally, when there is positive cash flow, that company will pay a dividend or do a share buyback. So not only are you getting an appreciation in the share price, but you're actually getting some income as well. So that's the opportunity. And as you highlighted as well earlier, the risk is you're relying on that management team and that company to build a project successfully and put it into production and generate the cash flows that they forecast. So there's the risk, but there's the reward as well.
Let me maybe pick on one or two things in Alan's presentation as to where I see the red flags. If I was in your shoes and flying business class everywhere, what would I be looking for when I'm meeting gold mining executives? The first thing is what you mentioned about people who stake out leases and then put in their annual reports, we've got this massive mining lease, when in actual fact it's not a mining lease, it's an exploration license. I mean, is that the sort of red flag that you would be looking for when somebody's over-promising, when they're using the wrong terms, in other words, to describe the nature of their lease?
Yeah, look, I think that's right, and I think you've got to look at a business and see a clear strategy. They've pegged a lease? Have they actually done any work on that lease, or are they just pegged that lease and sitting in an office in Perth, ducking out having macchiatos or something
Long
every
lunches
20 minutes, and
Place.
have they done work on the ground? Do they have competent technical people working with them? Do they have a clear strategy saying, we intend to drill this in 6 months' time? Here's who we've lined up to do this work. After that stage, we're going to do X, Y, and Z. And going back to Alan's presentation, there's a clear development pipeline pathway for them to go to see them doing that. And just understanding the industry, you ask some basic questions. So, okay, you've got X number of acres. How long do you have those acres for? How much money do you have to spend? What land do you expect you're going to relinquish? Have you talked to your neighbours? What sort of gold system do you think you're in? Show me an analogy. Show me another company that's in production, which is what you want to replicate in your business. So there's some of the basics things.
So you're looking for evidence, really?
Yeah, that's right. And I don't think it matters what industry you're in. Unfortunately, there are always some unsavoury characters who are looking to prey on naivety. But just look at the general business fundamentals and that there's a clear strategy of where that company's trying to go, and that the people, have a history of operating in that industry, or if they don't, that they're using people who do have a history, in that industry and ideally within that geography that they're looking to operate in.
And if they say things like, relinquish? No, we're not planning to relinquish. Presumably that's when you've got a sit up
Yeah,
and say,
and I think the point before about native title, you've got to look at the social and environmental aspects just as much as the technical. It doesn't matter where you are. You need to engage early and actively with the Indigenous people and give them a clear understanding. And a simple question is, well, okay, who's the leader of the Indigenous tribe in where your land package is, and how often do you meet him? What's his name? How many people are there? If you develop a project, do you think they'll have to be relocated? Where are you sourcing water from? Is that having an impact on the local people? Things like, are you, small cost things like, have you provided any books to the local community? Have you provided, a basic, and it doesn't matter whether you're in Western Australia or Africa or Asia, have you provided, some basic shelter, or, do you have a nurse or a doctor that you, bring out with you once every quarter who, checks the health of the local community? It's small things like that which, make a difference, and I suppose give good indications of people who are trying to do the right thing.
And also whether there's any job opportunities for those Indigenous populations as well. Engaging them in the operation that is going to be on their doorstep is a very important thing. Okay, so they might not have the skills initially to walk straight into a mining job, but large companies and many other companies tend to set up training programs for them from the grassroots and then integrate them into a workforce. Very important.
As far as, how long you give your investment is concerned, I mean, do you buy, let's say, a junior explorer who doesn't yet have a mine on the hope that they'll get something? If you do that, how long should you hang on to these shares before you say, okay, these guys are never going to find anything?
All comes down to your patience again and what kind of investor you are.
And risk profile and time horizon. But generally, Jeff, what about you?
Oh, look, I think, a group like us, we look at sort of a 5 to 7 year time horizon. So, and again, it's about your risk tolerance level. I mean, if you go with for example, we won't fund pure greenfields exploration because that is extremely high risk. But, the 1 in 100 that work are extremely high reward. But if you've got a company that I suppose that has some initial resources, if they haven't taken that to, through some basic economic studies in a sort of 3 to 5 year time frame, then I'd be getting pretty nervous.
Well, that's still a lot longer than some of these technology companies, right? If they don't double within the space of a month, then you'll be worried. Are there any final questions? In which case, please join me in thanking our panelists, Jeff McNamara and Alan Hawkins.